We got the latest fund manager survey from Bank of America Merrill Lynch delivering the key trends in global markets. The monthly FMS, this time for the month of July. Opinions and insight from 200 institutional mutual and hedge fund managers from around the world. This month's big takeaway, there are many, but here's one. Investors reducing cash and adding risk. Jared Woodard joining us now, Bank of America Merrill Lynch global investment strategist. He joins us from New York. And Jared, it matters that they're reducing cash and adding risk because relative to the really ridiculously bearish June FMS guide from you guys, it looks like things are improving a bit. What's your takeaway, Jared?
It is a bit of an improvement, John. If they were apocalyptic, in June, they're only incredibly pessimistic in July. So it is technically an improvement, although investors are still really bearish. You saw a drawdown in cash, you saw allocations to some cyclical sectors, but still, no one expects earnings growth, no one expects GDP growth, no one expects higher inflation or higher interest rates.
Looking at the pain trade then, you think it's higher stocks, higher yields. Just walk me through the thoughts, Jared.
Well, look, there's a very clear message for, at least contrarian investors this month, which is that if you want to get out ahead of, the crowd, if you want to get into a position with, a great risk reward for the summer, it's absolutely to be, long growth, long stocks, short treasuries on the view of higher yields. There's a massive consensus right now that we're back in that permanent, secular stagnation world, that the Fed's going to cut to zero, and there's not much else that's of interest. When everyone's leaning on that one side of the boat, contrarians can do well to tip to the other side.
And Jared, when it comes to the bond market, before we get to stocks, you just get the feeling the boat is completely loaded to the one side right now. I picked out a couple of stats from your fund manager survey this month. 1% of respondents think inflation rises in the next 12 months. 1%. Inflation expectations a 7-year low, and expectations for higher treasury yields, higher yields on bonds, the lowest since 2008. Jared, they are some stunning numbers, aren't they?
Well, they are. I mean, think about where we were a year ago, where we would regularly see 80 or higher percent, of these survey respondents telling us inflation was going to pick up. A year ago we had, 10-year Treasury yields breaking well above 3%. Now, we're facing the opposite scenario. The big question right now for investors on the macro is, do we get stabilization in Q3 in the global economy, in global earnings? If we do, as I say, I think there's such extreme positioning into Treasuries, into defensives, that if you see macro stabilization, you could see a real rocket ship type move on improving macro data. And
just regionally, Jared, also where you should be allocating capital, because looking at the most crowded trades, there's a real Buy America theme to it. Long US, long US. It's long treasuries, it's long US tech, it's long investment grade corporate bonds, it's long the dollar. What are you guys thinking about when you see those kind of trades all topping the most crowded?
Sure. I mean, so there was a little bit of a hint this month in where to think about next. You saw an allocation, to the Eurozone equity market higher this month. And if we do see the kind of stabilization in macro data that we think is plausible in Q3, then, European equities will be well poised to profit. Emerging equities, especially Chinese equities, which have been really flat this year, well poised to profit. Those cyclical, highly levered to inflation and growth sorts of regions of the world are places where investors have been light recently. That's where I would look next.
Picking out some other things where risk is being added, you mentioned the Eurozone, equities, industrials, also banks. Jared, key week for earnings season, the big Wall Street names report, going into the next 6-9 months. Your thoughts on the financials at the moment?
I mean, people still generally, I think it's safe to say, sort of hate financials outside of the U.S. There's some plausible reasons for that. We spoke, a few weeks ago about the pressure that banks are under in Europe from, negative interest rate policy. A lot of those pressures may not go away in the very short term, but they would be really, poised to benefit if you do see, potential for more earnings growth, potential for macro upside, especially if Chinese stimulus stakes hold. The other thing to keep in mind, though, investors are really keyed in on the risk to the corporate sector, including U.S. names. We saw, data in this survey where, a huge majority of investors are worried about corporate leveraging. It was actually at a record high. You also saw 3 out of 4 investors saying they're concerned about the business cycle as a risk to market stability. They think buybacks are too high. People are very worried that there's very few investment opportunities for corporates in this market, and they want to see higher growth and higher inflation driven by demand to give corporates a place to look.
So Jared, a record amount of respondents, I believe it was a record, did say that corporates were too levered. Do you see any of that view actually being expressed in fixed income markets, though, in high yield credit? Because I don't. Do you?
No, absolutely not. We've seen, it's been a record year of inflows to the credit market. You've seen investment grade funds see inflows, I think, virtually every week this year. High yield seen inflows. Emerging market debt is on pace for either the best or second best year in its history. So there's no evidence so far of investors shunning corporates. At the same time, they're thinking about, 6 months, 12 months ahead, where will the risks be? And there's where we see more evidence of concern.